All right, continuing on, chapter 3, taking this mask off. Commercial banking, unit banking organizations, unit banking. All right, so unit banks offer all of their services from one office, okay? And here's probably the most important statement relating to unit banks. This is how most new banks start out, one location, okay? They build their headquarters, everything operates out of that one building, okay? And then, as they want to grow, they decide to establish branches. Yes, I merged 2 slides. I took out some unnecessary thoughts and merged the 2 slides. So, it's typical for a bank to start small, doesn't require as much capital, as many people. They establish their reputation in the community, and then as things get going, cash flow starts flowing, they start branching, okay? And they'll offer a full range of services from several locations, and they may likely offer limited services through drive-up windows, which you don't see that often anymore, okay? ATMs, which you do see, and through the internet. Okay? It's all about providing services conveniently to customers, getting to the customer. Okay? We don't see drive-up windows much anymore. Okay? All right, but ATMs used to be a really big deal, and now they're fading, being replaced by mobile banking. All right, so senior management is usually located at the home office. So take Simmons Bank, for example. If you're going to work for Simmons Corporate, you're probably going to work in Little Rock. Okay? If you're going to, now, First Security is a large bank in terms of assets held, and they're located in Searcy, and they're doing some major building downtown, right off of the square. All right, but each branch typically has its own management, okay? And they'll have authority, limited authority, to make lending decisions. This is what community banks are all about. Having branch managers and lenders who know who their neighbors are, okay? This is what relationship banking looks like. Okay? So really there are 2 employment pathways in banking, if you want to go to work for a bank. And one is retail banking, where you are employed in a branch. Okay? And you're going to be working with small customers. And then the other is corporate, where you're going to be working in the headquarters. If you want to be do we have any accounting majors in here? Okay, so how many of you don't want to do public accounting? You all want to do public accounting, okay. So you all want to work 90 hours a week, 100 hours a week for 3 months out of the year, and then sit on your rear ends for the rest of the year. That's what you're looking at. If you want a more stable job, then you're probably, you'll be doing corporate accounting, and banks hire a lot of internal auditors, and you'll be working out of corporate. So that's a different path than going to work for a bank and working out in a branch organization. All right, so in the 1930s, only 20% of banks operated full-service branches. Okay? It's expensive, and at the time it was dangerous. And that's when the Chicago gangs were operating. Okay? And by the beginning of the 21st century, each U.S. bank averaged 12 branches. So there was an explosion of branching. And a big part of that was the move outside of the city limits. Of course, your generation is moving back into the cities. The cities are being revitalized, okay? All right. And of course, we said the Regal-Neal Interstate Banking Act provides the basis for the expansion of branching. Very important. If you wanted to grow your footprint, your market footprint, you had to cross county lines and you had to cross state lines. And it wasn't possible to do that until 1994. All right, now I personally think that what we're going to see is a contraction in the number of branches that we have in the United States. And there's one reason for that, and that's the internet. The ability to provide services without having to invest money in a piece of property, real estate, land, and then have to build a building. It's expensive, and the returns aren't that great. So what banks will do is they'll migrate more and more services to the internet, and they'll pass the savings in part along to customers through higher deposit rates. You'll be able to earn a higher rate on your checking account and your money market account because the bank doesn't have to pay for all the branches. All right. So why did government support interstate banking? Okay. Well, for one thing, they wanted money to be able to move from rich areas to poor areas. Okay. Remember, the job of a bank is to help develop the local economy. All right. And if you have a struggling local economy, it means there's not a lot of capital there to help you grow. And it was difficult to move money from wealthier areas in one county or one state into poorer areas in another county or another state. So you start breaking the walls down and allowing branches to cross state lines, then you can take deposits in one area and use those deposits to fund loans in a different area. Okay, and so that helps with economic development. Okay. All right, the non-bank financial institutions didn't have any problems crossing state lines. And anytime you start talking about regulation, one of the big topics of discussion pushed by the group being regulated is the ability to effectively compete. Okay? Well, those guys can do it, but you're not letting us do it, which puts us at a competitive disadvantage. And the question then becomes, does Congress give you certain things that you can do that creates a competitive advantage that offsets what those guys are doing? And that used to be the case, but not anymore. The barriers have broken down, and the non-bank financial institutions can offer a lot of the same services that banks can. All right. So the largest firms wanted to be able to geographically diversify their operations. They wanted to spread their business, their customer risk, out onto a larger area. Okay? They wanted to be able to sell their products and services to new groups. Okay? So that was really important from a strategic standpoint. Okay? So the regulators thought it was a good idea because they felt that the larger firms had more resources to work with. They can invest more in compliance, in smarter people, more people, better information systems, and they could deal with compliance more efficiently and effectively. All right. So One impediment to doing business over a wider area was technology, and that's gone away. Technology is no longer an issue. They can do it. Okay? You can manage that process now, where it was very difficult before. All right. So, as I said, branch expansion has slowed. We have as many branches as we need, and as I said, we probably have too many at this point. The industry is being disrupted, like all industries are, because of technology, and what was once an advantage for banks that had a lot of branches, probably a disadvantage now. Too much cost. Okay? So I don't know how many times we have to say this, but you know, you've got ATMs out there. You don't need a full, you don't need a branch. You don't even need a drive-in window. You can have an ATM, and then it's all going on. All going on. All right. All right. So back in 1934, we had 14,000 banking companies out there and 3,000 branches, a total of 3,000 branches. Fast forward to 2010, and the number of independent or separate banking companies has been cut in half, and the number of branches has exploded. And I think we'll see the number of branches come down as internet technology gets better and better. All right, so we see in 1988, 1989, we had a large number of banks that were chartered, and we also had a large number of banks that failed. And then that was repeated in 2009, 2010. You can see, so in 2006, in 2005 and 6, we had no banks fail. In 2009, we had 140. In 2010, 157. That's the financial crisis. I'm not exactly sure what's behind the 1988, 1989 thing. So, if anyone wants to do a little presentation on why we had so many banks fail in 88, 89, that might have been, Vinay, okay, you can do that. That might have been one of the real estate bubbles that we had. As I recall, the real estate bubble really hit hard in 1990. But check that out and see why we had so many new banks, or particularly why we had a lot of banks that failed. And that may have also, so bank failures kind of jumped up in 85, and I don't know, just check that out. I think the tax laws, so Reagan came in 1980 and started changing the tax laws. And then we had, the next crisis we had was in 86. Some of the laws that were changed in 80 were reversed in 86. And we had the S&L crisis, and we had a limited partnership, a bust of limited partnerships, which affected oil and gas and real estate. And that may be what happened there. So check that out and see. Again, it was a combination of bad government policy, which motivated a lot of sketchy behavior by business people. All right. So now let's look at, take a deeper look at some of the organizations, how banks are organized. So holding companies. So what is a bank holding company? Well, a bank holding company is a corporation chartered for the purpose of holding the stock of at least one bank. So it's a corporation that holds the stock of another corporation, okay? And it is also set up, that's why they call it a holding company. It's also set up to hold the stock of other businesses. So it's a conglomerate, all right? So we've seen a big rise in bank holding companies being chartered, okay? And now 84% of banks are part of a bank holding company. Again, this is a business strategy, strategic decision by bankers how they want to manage their companies. Okay. Why have we had these? Well, once again, you're trying to use people and technology to create economies of scale. So once you have a certain level of administration put in place, what you want to do is push as much volume through that cost structure as you can. Okay? All right. Banks were dying to jump into businesses outside of banking, the securities business, and the insurance business. All right? So when it comes to managing capital, how bank holding companies affect capital. Well, these bank holding companies tend to be large, and so they can more easily access the capital markets. And because they're in different kinds of businesses and they're large, typically the market allows them to use more leverage, borrow more money. So the bottom line is they have access to capital, and more cheaply. Okay? And they can put that to work to grow. All right. The book made a big deal out of this, so I'll mention it. Tax advantages. Okay? So here's how it works. The bank holding company can issue debt. Okay? Because of their size, they pay a lower interest rate on that debt. And they can deduct the cost of interest. Then they can use the money as equity in one of the banks or more of the banks that they hold. So they can borrow money and turn that borrowed money into equity. And at the same time, they can deduct the interest. Okay? So another thing they can do, so that's kind of a fancy thing that they can do, tax loophole if you will, is they can move money from one subsidiary to another in order to meet reserve requirements. So it's kind of like Fed funds where you're borrowing from another company, only they're doing it internally. Okay? So there's some games that these companies play that help support them as bank holding companies. But the main thing that they're doing is they are offering a broader range of services, but they're doing it in a way that if the insurance company gets into trouble, the capital of the bank is not affected. Thank you. That's what a bank holding company does. It protects the capital of each separate subsidiary. So if subsidiary B gets into trouble, it does not impact subsidiary A. And that's really important because subsidiary A is a commercial bank. And so the regulator said, you want to get into securities, brokerage, investment banking, you want to get into insurance, you can do that, but only through a bank holding company, because we are not going to allow a commercial bank to be put in a threatened position. So we're going to protect the commercial bank and the capital. All right, so here are the big banks. big bank holding companies. So there's Bank of America, Goldman Sachs, Morgan Stanley, okay? So I want to point out that during the financial crisis, Bank of America bought Merrill Lynch, a brokerage firm, because they became a bank holding company, okay? Goldman Sachs and Morgan Stanley were investment banks, and they filed for commercial banking charters, okay? Because it stabilized them and it gave them access to capital that they didn't have before. Okay, so they're now considered to be commercial banks. They're part of the bank holding companies. All right, there you go. All right. So most bank holding companies only own one bank, but then they own other non-bank subsidiaries. Okay, that's the purpose of it. All right, this is repetitive. Gotta work on that. Principal advantage. Okay, diversifying your revenue and your profits, and which reduces your risk, isn't it? Okay, it stabilizes your revenues and earnings. Okay, and so it stabilizes it by product line, and it stabilizes it by geographic areas. And we talked about that already. This is a repeat. So this is something, this whole paragraph we've talked about before, right? So can I take that down for future reference? Don't need it, do you? How many times do we need to say it? These are all the advantages that come from interstate banking and from bank holding company organizations. Everybody caught up? As Forrest Gump would say, and that's all I have to say about that. Billy, catch up. You there?
No.
Come on, man. Just not that many blanks. Isaac Dodds is giving you the stink eye, Billy. No? You ready?
Yeah.
You giving up?
Yep.
Take a picture of it.
No, okay, I got it.
All right. All right. So there are some bank holding companies that own more than one bank. Okay, like I said, most of them have one bank and then other non-bank subsidiaries. But this is what it looks like. Okay, so each bank is called